person on a beautiful day here in Vancouver. And we have a bunch of people coming online as well. So welcome to those watching online. Who's blocking the screen? My name is Angie. I work with New Ventures BC. Justine is also at the back with New Ventures BC. So thanks for joining. I have a few housekeeping slides and details, and then I'll pass it to main show, just Keith Ippel. And for those who come, I don't know if anyone's come every week, but I don't say this is my favorite talk every week. So I'm sincere when I say this is one of my favorite talks. It really is. So first I would like to, of course, this almost check to this. Okay. We'll figure this out. Hold on. Is it?
Yeah, there we go.
Okay. Okay. Reset
Just gonna
there.
get rid of that bar
Okay.
while I'm here.
All right, thank you.
Okay.
So yes, I would like to respectfully and gratefully acknowledge we are on the ancestral and unceded territory of the Musqueam, Squamish, and Islander First Nations. Okay, I'm gonna go manual while I figure this out. So I always say New Ventures BC is a nonprofit. We are very fortunate to have been doing this competition and the seminar series for 25 years. I always say the first winner of this competition 25 years ago was this crazy company called AirG, making these crazy things called mobile games on your phone. It's come a long way. So, and we're here because we have really great sponsors that allow us to do what we do. So our title sponsor, and they've been our title sponsor for, I think, 15 years, Innovate BC. And as part of Innovate BC, this year we are part of the Road to Web Summit, which are just a series of events to help prepare startups for the Web Summit happening at the end of the month. Other sponsors, EY and Baskin. Silver sponsors include RBCX, SFU Beauty School of Business, Talk Shop Media, and Vantech Angels. And then we have lots of ecosystem partners. And I'm going to add Spring to this as well, because Keith's going to announce a nice little perk for you all at the end of this. And we're really happy to have Spring joining this great list of ecosystem partners. Like I said, this is part of Road to Web Summit. So R2WSV, if you Google that, you'll get a list of what the event's about, all the upcoming events. There's multiple organizations in the ecosystem doing events. Keith, do you have anything coming up, or you've done yours already?
I'll announce a couple at the end.
Perfect. Okay,
Yeah.
so there's more to come on that. And some events as part of Road to Web Summit, Life Science BC, they're doing a pitch event coming up. And I believe this is SFU Venture Labs. This is also related to financing. I believe it's more venture capital focused though, so slightly later stage. And that's part of what Keith will tell you about today. That's it. That's all I have. So I actually am going to let Keith introduce himself, but I will say that Keith Ippel has been a partner of New Ventures BC for a long time. And both as a speaker and also a partner in some of our other programs. We're very grateful for the collaboration, and you're all in for a treat because, like I said, it's one of my favorite topics. So Keith, over to you.
Thank you.
Thank you. You want to yes.
Absolutely no
Yes.
pressure whatsoever. Good afternoon, everybody. We worked it.
Yeah.
Awesome, thank you. How's everybody doing? Great. I have the good fortune of giving a lot of talks around the world, and because I do it outside of Canada as well as within, the joke that I always like to say is, if I was an American, I'd say, hi, my name is Keith, but I'm Canadian, so I say, sorry, my name is Keith. You are entrepreneurs, so you say neither. You say, I need money, my name is Keith. And that's what we're going to talk about today. Is we're going to talk about fundraising. And what I want to do is I want to lay the groundwork for this process that you're going through. How many people have never raised from investors before? A lot of first timers in the room. How many of the rest of you have PTSD from trying to raise? Yeah, and I agree. And so part of the process for me today is to do a couple things. One is lay some groundwork for some of you who have never raised before. Second thing that I want to do is I want to maybe give just a little bit of what I will call, April 2025 context. So what are some of the trends? What are some of the things that you need to know, just to help you in this specific context that we're all kind of navigating right now. as startup entrepreneurs and founders. And I'll also set the table for some of the things that can follow after this. One thing that's very important to note is that it is a journey, right? Raising around. It would be very nice if we could, raise around in 3 weeks or less. I did see that happen once in my life, but just once. And so most of the time, for most of us, it's a good 6 to 12 months to raise like a pre-seed round or like a heavy angel seed round. Sometimes when you start getting involved with VCs, it can start to drag out a little bit beyond that. So our goal here is to also acknowledge just where we are in the journey and kind of set ourselves on the right path for success. Does that make sense?
Yeah.
Fabulous. Before we get started, anybody have any burning questions? Like just things when you're coming into this room today to say, hey, like I really need to get an answer to ... Any of those questions coming in, would love to hear them. Go ahead.
I'm just gonna ask you later to make comments on what's it called? Crowdfunding for selling shares directly to the public or selling shares on a platform that allow you to quickly raise a certain rounds.
Quickly raise certain quickly is a state of mind for all of us always. So specifically what James is referring to is a subset of crowdfunding, which we call equity crowdfunding. And equity crowdfunding first started in Canada in, I believe, 2015. So it's been about 10 years now. Well established in the UK, a little bit longer than Canada in the US. And the premise behind equity crowdfunding as a concept is that you can raise from the crowd. So any retail investor or any Canadian can invest in your company through an equity crowdfunding campaign. But any Canadian cannot invest in your standard round. So that's one of the appeals of an equity crowdfunding campaign. You can literally raise from anybody. Pros and cons, we'll make some time to talk about that. So thank you for that, James. Anybody else? Any other starting points? Go ahead. And by the way, if you do say, just say your name, say your company name, and then your question. Okay, great.
Armin with the door face panels, and I just want to know, do you think investors are just waiting for the dust to settle down as crunch that they are, or are they going to move ahead?
Yeah, this is actually one of the most unique times in the startup world for capital. And the reason I say that is because if you go back to the late 80s, the economy, generally speaking, has this like boom, bust, right? So we're thriving, everything's moving, then there's a recessionary event of some kind, there's a dip, and then we come back up, and we kind of have repeated that cycle over time. And so if you go back to the late 80s, early 90s, and you go to the late 90s to kind of 2001, 2002, then you do 2008 to 2010, those were all recessionary times. Typically speaking, in the first year and a half of recessionary times, the investors more or less sit on the sidelines, kind of wait and see what's happening. A subset of people are still investing, and then pent-up demand, the economy starts to move and investors jump in full swing. Now, we're in a very unique time because, March 2020, everybody got locked at home. So there was a moment there for about 6 to 8 months when investors sat on the sidelines being like, what the heck is going on with COVID? Then they jumped back in. So it was pretty quick. But then 2023 was economic uncertainty because it had been 13 years since we had any form of a recession. So people were like, okay, the pin's going to drop. So people started to sit on the sidelines in 2023. Anybody try and raise around in 2023? Like tough, right? Really tough. And so the going assumption was we would get to the end of 2024 and then everything would open up again, which it started to do. And then a certain country south of us had an election. And then all bets are off now, right? People are like, tariffs, what does this mean? Does it affect me personally? Does it affect my portfolio companies, my prospective portfolio companies? So there's an interesting question, which is, because investors sat on the sidelines twice in the last couple of years, can they even afford to sit on the sidelines now? So I will say in our particular context at Spring, and I am giving you a bit of a prelude for what we're going to talk about, but Spring, the work that we do, we work with early stage entrepreneurs. We've worked with more than 3,000 in the last 10 years. And through that process, I would say that we have seen as much or more investment activity in the last 5 months than we saw in the first half of 2024, probably first 9 months of 2024. So there's actually a lot of capital out there. Now, I will caveat this. If you're enterprise SaaS, if you're HR software, if you're ed tech software, it's still tough. But there's other categories, like if you're foundational AI, if you're clean tech, if you're health tech, women's health, femtech, circular economy, like these are sectors that are moving, right? And so just an interesting time, still trying to read the tea leaves, but the sense is because the investors were on the sidelines for a little while, they got to play. They got to play. VCs especially, right? Because VC sat on the sidelines in 23. A venture capital fund, in case you don't know, a venture capital fund is not a person, it is a legal entity. Structure is called a GPLP fund structure. So it's a legal entity. They have a set lifespan. So they die after 10 years, possibly with a 2-year extension. So they have to invest typically within the first 2 years, and then they manage that money for the next 8, and then they have to return the capital to their investors. So because they sat on the sidelines in 2023, they're desperate to deploy now because they have to hit the window. Like they're running out of time, like because of the legal structure. And so just as an aside, it's actually a really good time, especially with climate, especially with health. There's a lot of VCs who are compelled to deploy right now. So for what it's worth. Yeah. That's, by the way, impress all your friends in your next cocktail party with that one. Okay. Tough crowd. Good. You had a question.
Yeah.
Name, company name.
Also, React Materials.
Okay.
The question is, how do you decide your valuation number for your company? Pre-revenue and then post-revenue, but without profitability?
Great. Valuation is a very important question. I'm going to give you guys a sneak peek. One of the things that we're going to be doing coming out of here is we're going to be providing you with a Spring resource that is in depth on all things fundraising, and there's an entire section on valuation. So it is important to note that for everybody, a couple of things. One is when you're raising money for your business, there's typically 4 ways to do it in terms of paperwork. So 2 are what we call priced rounds, and then 2 are not priced rounds. So if you've heard of common shares or preferred shares, those are priced rounds. That's when your question comes into play today, right? So if you're offering me common shares or if you're offering me preferred shares, that's what we call a priced round. You must put a valuation on the company. So that's point number 1. Point number 2 is for the non-priced, we use convertible notes or convertible loan agreements or SAFE agreements. SAFE agreements, if you have not heard that term before, SAFE is an acronym. Simple Agreement for Future Equity. Okay. And so these 2 types of paperwork say, I'm going to invest in your company today, but the valuation upon which that happens is actually going to be determined at a future date. So the term that we use in the investing world is we're picking the valuation down the road. With a convertible loan or convertible note, that is typically a set term of 2 years. So first and foremost, if you're doing a SAFE agreement or a convertible note, the benefit that you have is you actually don't have to set the valuation today. Now, if you are doing a priced round, the number 1 way, if you are at the stage that you described, which sounds like pre-seed, if you're at a pre-seed stage, the number 1 way that you value the company, which is also, by the way, GAAP approved or generally accepted accounting principle approved, is called comparable transactions. So what you would do is you would go into PitchBook, AngelList, Crunchbase, Hockey Stick, a couple of other platforms, and you'd be like, what are some recent deals in my space that have happened, how much did people raise, what were the terms? And then what you would do is you would come to me and say, hey, Keith, here's my company, I would love to tell you about it. You'd like, great, and then I'm like, hey, so what are the terms? And you're like, I'm doing a common share round at this valuation. And I'm like, where'd you come up with that? And you would say, thank you for asking. I use comparable transactions. Here are the 6 deals I compare against, or 4 deals. Typically, you need a minimum of 3, 6 on the high end. And then what you would say is, based on these deals and how we're unique in the market, we peg it at this relative to what they did. Does that make sense to everybody? So it's a very important question. The reason, by the way, we use comparable transactions is why? How much revenue do you have today? 0-ish. So the point being, if you tried to say, hey, listen, I'll do it as a multiple of revenue, then your company's worthless, right? So the important part is we're actually valuing our company in a strategic way, not in a financial model way. Now, there are a couple of other ways that you can value the business. So if I were to answer this question fully, plan A, comparable transactions. Plan B, you would use discounted cash flows on your forecast, or DCF model. That means you have to forecast out a good 5 years. And then you would create a DCF model as a backup plan, such that if I was like, no, tell me how you actually think you're gonna make money with that revenue model. What's the forecast? How big are you gonna grow, et cetera? But I'm asking that question not to determine valuation. I'm asking to understand how you understand your business and how you build your model. Does that make sense?
Yeah.
Yeah, it's a really good question. So the important part for everybody here is there's 4 ways or 4 paperwork methods upon which we raise capital. Priced is common share preferred. Unpriced is convertible notes or safe agreements. Now here's this, remember I was saying earlier, what are the trends today? So April 2025, 75% of the deals that have been done in the last 12 months, safe agreements. And the reason for that is economic uncertainty, macroeconomic, macro political. People don't know what's going on in the world. People are like, you know what? Let's not try and figure out the valuation of this company. Let's create an agreement where we'll determine it in the future. Okay, go ahead.
When you say 75%, are you talking about in Canada or North America?
Canada. Yeah, that's the Canadian stat. Yeah, my experience with US, Singaporean, UK, Scandinavian angels and some VCs is anecdotally, I would say it's probably at least 50% in pre-seed stage and most seed round. So
Canada is a little bit higher than the average?
a little bit higher than the average, yeah. And the reason, just so you guys know, is we actually don't have a lot of VC funds in Canada. Our capital market is more determined by what angels do. So that's why you see, I think that would be my hypothesis. Does that make sense? Yeah. Killer. One thing that I am gonna say as we get started, and by the way, I also been doing this because I know typically with a 4:30 start, this is Vancouver, so you know, 5:05 is probably 10 minutes early for most people in Vancouver. So so I am, you know, just kind of covering off a few questions before, you know, the last few people straggle in, but I am gonna dig in. One thing that I want to highlight for everybody is, as we talk through this, so I just gave a conversation where I actually gave, I think, a reasonable amount of clarity to the question, how do I value my business? But you notice I gave a lot of variables. So one thing that I want everybody to visualize here is this is going to be the single most complex BD deal you do. Right? And there's a few reasons for that. One is, first, if all of you were potential customers for my business, every one of you would sign an individual sales contract. And I could negotiate with you, you'd sign it, I'm done. Then I negotiate with you, you sign it, done. This is actually, if I'm raising from you guys, I need all of you to agree to the exact same piece of paper and then sign it, right? So it is the very physical embodiment of herding cats. So the reason I say that is this is where a lot of these variables come into play, because if you came to me and I said, hey, let's do a safe, right? But then you might chat with this gentleman and he's like, you know, I just really like convertible notes. So then you're like, okay, which way do I go? So the visualization all of you want to have when you're going through this process of raising capital is you have a table like this and you have a pile of dominoes on it. And the dominoes include like, each domino is an angel investor. There's dominoes for VCs. There's dominoes for paperwork. You know, there's dominoes for progress in the business. And what you need to do is take the pile in the middle of the table and you start to form like, I call it a domino path, right? And because the whole point is your goal is by the time you lay all the dominoes out is you press one and it just all tips, right? So as we go through, you're going to start to hear some of these variables. And so if at any point in time, you're like, Keith, like that's starting to get confusing or there's too many variables, my comment is it's okay. There are a lot of variables at play. We'll talk through them. Our goal is to make sense of them all so you guys can see the domino table. Does that make sense? Fabulous. You guys never thought we'd talk about dominoes today. Here we are. Awesome. We have gone through land acknowledgement. Thank you very much for that. Huge shout out, of course, to New Ventures BC. They've been supporting entrepreneurs across the province for longer than Angie and I've been born. That's what I'm going to say at this point. But glad that you're in this room and you're a part of this experience. So you might be wondering who I am. For those who don't know me, my name is Keith. I run an organization called Spring. Spring exists to change the world through innovation. What does that mean? We work equal parts with early stage impact entrepreneurs and early stage impact investors. Over 11 years, we've worked with more than 3,000 entrepreneurs and businesses across Canada. We've worked with more than 1,100 investors, angel groups, venture capitalists, et cetera. Everybody trying to make the world a better place. So in this particular context, what does that exactly mean? In our world, that means clean tech, health tech, sustainable food and ag tech, circular economy, sustainable supply chain, retail logistics, sustainable real estate. So we tend to touch those categories more often than not. We do a tremendous amount of work with women founders. About 65% of our businesses have been women-led, co-led. And just as a highlight, you know, the current stat, which has been the same for 15 years, is last year about 2.3% of capital went to women-led ventures, which is ridiculous. Over the last 5 years, 68% of the capital through Spring has gone to women-led co-led. So we believe it and we walk the talk. And so that's why we're here. So just to give you a bit of an example, we run a series of programs specifically designed to matchmake founders and investors together. And so in the last 5 years, we've had about $60 million get catalyzed at pre-seed and seed. And so we have seen a lot of capital get deployed at your stage. So trust that it's there. This is just a bit of a roll call of some of the companies that we've worked with over the last little while and have had great pleasure in doing that. So about me, I'm a serial entrepreneur. Because I'm a serial entrepreneur, I'm 28. This is what happens when you're a serial entrepreneur. Right? Thank you. And so, but just to give you a bit of a sense, ironically, the first company I advised was Hootsuite. So then I thought, oh, everything's a unicorn, you know. But ironically, that's not necessarily true. But I have had some great success and seen some companies exit as well, like EHS AI, Foodie, and others. Spring not only works in Canada, but about 26 countries around the world. So definitely can bring not only a North American perspective, but also a global perspective. So we're going to talk about a few things today: overview of funding cycles, data room structure, which is always an important starting point, especially for people who are raising for the first time, just getting in and kind of understanding the basics of that. Starting your investment round, tips and tricks and trends is where I'm going to spend the bulk of our time. Any questions before we get going? And just for the people that are online, Justine is with the New Ventures BC team. She is tracking all the online questions. Anytime you raise a question in chat, Justine is going to raise her hand at me, may need to throw something at me, and then we'll answer them in turn. If you guys have questions at any point in time, please, like I got slots for Q&A. But if you have a question or something's confusing, just raise your hand and we'll go. Go ahead.
They can't quite hear the questions over here. So if we could ask that you project your voice more or you could repeat.
I will repeat them. Thank you for the reminder, Justine. Thank you. Great. Any questions? before we get started? Awesome. Okay, let's dig in. So again, engage throughout the session. We've already done this, your name and company when you engage for the first time. This is something very important, right? There is, you guys need to hear this, zero rocket science in raising capital, right? It's not voodoo. It's just like, frankly, it's sales. Difference is you're not selling your product, you're selling a share certificate. Same thing, right? So let's demystify this right now, right? It's a trust-based relationship sell. That's what we're doing. So, but lots of funky terms and terminology. So if I do start to throw out terms that are unfamiliar to you, just shout out dictionary. I'll give you the definition and then we'll go from there. Make sense?
Yeah.
Great. We talked about some burning questions already, so let's get into the fundamentals. So the important part here is most of you, if not all of you, came into this room thinking, okay, I'm going to raise from investors. So it is important to note, investors aren't the only way to raise capital. And so I just want to make sure that as you start working this process, depending on how you define it, there's approximately 7 different sources of capital, possibly 8, for your business, right? So number 1, your back pocket. Number 2, revenue. Number 3, friends and family. 4, equity. 5, grants, loans, equity crowdfunding, which was mentioned earlier, crowdfunding in certain contexts, or competitions. Okay, actually I got 9 different ways to raise money. So my encouragement to all of you is to remember equity is not the only way to raise money. And I will tell you that any investor, I'm going to say north of, call it the Mason-Dixon line, like, like New York, Chicago, Seattle, Portland, they all know about all the granting programs and like everything that exists in Canada. Of course, all the Canadian investors do. So just know, like, if you're looking at grants, if you're looking at loans, you're looking at other ways to add capital to the pool that are non-dilutive, investors give you credit for that, right? That's good, smart capital management and cap table management, right? If you don't know the term, cap table is basically the list of everybody who owns shares in your business and at what percentages, okay? And so, please do remember always, if you're doing an equity round, money in exchange for equity, I own a piece of your business. We are now married, right? We are wed until this company exits, fails, IPOs, whatever. So please always treat your equity dearly, right? It is important to remember that, okay? Okay, so funding cycles. A couple of things worth noting is that they do move at the speed of relationships. So I'm going to ask a trick question, which sometimes, if it lasts a while, it hasn't been as tricky as I thought. Average amount of time that it takes an investor to make an investment decision when hearing a company, like, or evaluating a company. Any guesses?
5 minutes.
5 minutes.
6 months.
6 months. Any other guesses?
7 weeks.
7 weeks. So, we actually have done some surveying at Spring, and I know a few other angel groups and angel organizations that have done this. The average angel investor makes their initial investment decision 15 minutes in the first meeting. Very close. They spend all the rest of the time in due diligence, either affirming or denying that decision, right? And so the reason that this is important for you is because what they're trying to do is they're trying to build trust, right? Because anybody here doing 10 million in revenue? Exactly. So if you're not doing 10 million in revenue with 5 years of financial statements and 3 years in a row of profitability, I can't assess you financially. I can only look at you and say, do I trust you and your team with my money? So after 15 minutes, the amount of time I spend with you is based on my own risk return kind of thesis. Like, how risk averse am I naturally? And then the other one is to figure out if I trust you. Like, that's all it is. I mean, it's a lot, but that's what you focus on, right? Now, the other one is it's seasonal. So, I have actually tracked this over the 25 years, so, almost 20 years that I've been advising companies. And any guesses as to the number of checks that I've seen written by investors between July 1st and August 31st? Any guesses in 20 years?
Well, zero.
I see zero. Zero? Yeah, 8 in 20 years, individual checks, not rounds, individual checks. Why?
Holidays.
Vacation. You know, south of France in the summer, Whistler in the winter, right? So it is important to note that fundraising is a seasonal exercise. So you will not raise a round between July 1st and September 15th. In addition, you will not raise a round from December 5th to January 15th. You just won't. Now, if you were in Singapore, it'd be different because they have different vacation cycles, right? You know, go to Vietnam, you're not gonna raise $1 in February because it's Tet, right? So just acknowledge in the North American context, that's true. So if any of you are sitting here now and saying, hey, yeah, I'm planning on, you know, raising my round in July. You now know you either need to step on the gas and get it done by the, 25th of June. Or you need to have a plan B because you're gonna be raising by October, right? And so my encouragement to you is don't be frustrated by it, embrace seasonality, right? So that's very important in this mix. And then just always, it takes longer than you think. Always, always, always. Go ahead.
Wanted to, not a question, but wanted to add, that there are certain cultures.
Just share your name so everybody knows.
Prashant from
Prashant.
Pacific.
Thank
I
you.
wanted to add that there are certain cultures, if you're raising money, where raising money in holidays is what they consider auspicious, and you raise a lot of capital internationally, for
Okay.
example, Europe and Asia.
Right.
So in certain specific regions in Europe and Asia, you can actually raise more money during the holiday than you can otherwise.
And just so you guys know, one of the benefits that you have today, and there's a lot of benefits of raising around in 2025. One of them is COVID. Right? I always talk about this all the time, unintended benefits of, there's unintended benefits of elections, there's unintended benefits of tariffs, there's unintended benefits of COVID. And one of the unintended benefits of COVID was in the first 6 months, a whole bunch of investors did their first deal over Zoom. And when they did that, they're like, well, hold on a second. I can invest anywhere. The amount of cross-border deals we see now. So there's a company, if you guys are curious, if you want to see this, Open Ocean Robotics. It's a Victoria-based company, solar-powered drone boat company to protect the world's oceans. Their last round, 2 Canadian VCs, Singaporean VC, Norwegian VC. First time ever in Canada. Like, that's the kind of stuff that is happening now. So that kind of research can pay off. So just playing that out. So how long does it take to close? Sorry about the funkiness on this, but you, friends and family, anywhere from 2 to 6 weeks, depending on conversations. Revenue is supposed to be 4 to 52 weeks. Sorry, my apologies. You have to grants and loans a little bit longer. Crowdfunding and equity crowdfunding is 3 to 6 months. So to James's earlier comment about raising easily on crowdfunding, that's the de facto number. From the moment you say, I want to go do an equity crowdfund to the cash in the bank, 6 months is the average. Right? So the reason that all of this is important is if any of you are sitting in the room saying, great, I want to raise money and I got 12 weeks or less. Okay, great. Here, everything else doesn't apply. There's nothing wrong with that, right? We understand our constraints, we embrace the constraints, and we maximize our opportunities within them. Final comment that I'm going to make, again, as a serial entrepreneur who's worked with a lot of companies, you guys, we never talk about that. There are as many pros and cons to you investing in your own business as any other capital source. So my encouragement to you is when you guys leave this room, you're going to look at your bank account. What you're going to do is you're going to take it, you're going to cut it in half, you're going to withdraw it. You're going to go to your mother's house and you're going to hide it in her mattress. Right? Please remember, your money is the money that is called the bank of last resort. Right? Because every company has ups and downs. Right? And when you go down, the only person who will invest is you. Right? So please, if you guys have money in the bank, set it aside for the rainy day. You're the rainy day investor. Nobody else will be. Does that make sense? Great, go ahead.
Quick question, what would you say is on average for pre-seed round? Is there a sweet spot as far as dollar value? Is it 50,
Okay.
100, is it 500?
Yeah, so for the folks online, question being, if you're doing a pre-seed round, what is the sweet spot on amount?
Yeah.
So, there is, it's a great question. There are a couple of variables that actually help you construct any round, including a pre-seed. So one is the amount of money, which is what you're describing. So typically, when we think about the amount of money, we think we have a target amount. I'll use a round number, 500,000. And we have a reason for that. We looked at our forecast and, you know, like, we think we need this amount of money to like good 12 months of runway, like, et cetera, et cetera. I'm gonna invest it in these ways. So that's kind of starting point number one. Starting point number two is half. So in other words, what if I actually can't raise 500,000? What if I can only raise 250 or 350? So now what we do is we start to set a floor on the round. And then you could say, okay, well, what if I could raise more? What would I do with more? Right? And so typically speaking, that's the starting point, is the amount. The second one is when you start to think about valuation, and there's a term that goes along with valuation that some of you know, some of you don't, and that's dilution. Right? And so the premise behind raising a round of capital is, if you're gonna raise 500,000, we as investors are gonna get X% of your company, which is that dilution amount. You know, he dilutes his ownership by, right? So you're trying to play those two numbers. And the reason is because, to your point, there's like a psychology to how much you raise, but there's also a psychology to the value of the business. And those numbers actually together need to make sense. So I'm gonna share something with everybody here, which I've been told many times I'm not allowed to say this out loud by other investors, and so that's actually why I love saying it out loud. But if all you guys are raising right now, and I walked into the room for the first time, and I look at you, I know nothing about you. I don't know your name, I don't know your company name, I know nothing. All I know is you're gonna pitch me. My immediate assumption is you're gonna give up 20% of your company. Period. That's the default assumption at pre-seed and seed. And then once we start to talk, then it's like, hey, if you're like a rock star, then maybe you're gonna give up a little bit less. Or maybe if you've got a few skeletons in the closet, then maybe you're gonna give up a little bit more. Does that make sense?
Yep.
Okay, never give up more than 30. If you're giving up 30, they're predatory investors. I'm just calling it for what it is. Please do know that's less than 2% of the deals that I see. Most investors are good people, just be clear. And so if they see enough skeletons in the closet, they're not gonna ask for 30%, they're just gonna walk away, right? Now, remember I mentioned Hootsuite earlier, and I assume most of you have heard of Hootsuite. Like when Hootsuite did its pre-seed round, Hootsuite had gone from 0 to 1.6 million business customers in 11 months, gave up 7% because they were the rock stars, right? You know, so, but it's straight up the middle average, 20%. So now let's play this out. If you're like, okay, how much should I ask for? Let's call it 500,000. Now you can start to see what your pre-money and post-money valuation needs to be. Because if I'm assuming 20%, we're 2 million pre, 2.5 million post, 500,000 divided by 2.5 is 20%. Does that make sense? These are baseline numbers that we start with, right? And so what I would say right now is in the pre-seed rounds that I'm seeing, the range is probably 250K to 1.5 million in Canadian dollars. I would say the average that I'm seeing right now is probably in the 500 to 750 range. It'll be interesting to talk to some other investors to see what they're seeing. Part of that, in my case, is colored a little bit by the fact that the majority of deals that I see are clean tech, health tech, right? So it can vary quite a bit. And I would say separately that, yeah, I would say it will also depend if you're software only or like a mix of hardware, software, or pure hardware, like hard tech. That will also impact the amount that you raise. So the more hardware you have, the more hard tech you have, the expectation is those first rounds are gonna be a bit bigger. Because just sheer like getting to pilot and getting to prototypes, getting a minimum order quantity, like those types of things start to come into play. So it is variable. Now, here's my encouragement to you. Hopefully you guys have great startup lawyers. If you do not have a great startup lawyer, there's some great law firms here in town. Off the top of my head, Inc. LLP, Osler, Faskin would probably be the three that typically come to mind the most. There's also other great firms out there, and I'm not begrudging any of them. I'm just naming the ones off the top of my head that I think are great. First, you would go to your lawyer and say, what deals have you seen? Next thing you would do is you would actually call up Aaron at Vantech, and you would call like Irene at Angel Forum or Women's Equity Lab and be like, what are you seeing out there? Like before I go raising, like I want to know so I don't sound crazy, right? And the reason is I had a company yesterday come reach out to me and they're like, hey, I'm raising a pre-seed round, 65K. And I'm like, this call just cost you 65K, you know? So you need to be thoughtful about that. And on the flip side, you don't want to say, hey, I'm raising 5 million in a pre-seed. You know, so you need to kind of get a handle on what is the normative range out there. This is also why, by the way, if you guys are going to do one thing before the end of the day, you guys are all going to exchange LinkedIn information because you're all raising. Share what you find out. Share what you hear from Vantech Angel Forum, from, I don't know, Panache Ventures, Active Impact Investments. Like find out what they're saying. What are they expecting to see? What's the average paperwork, etc. Get yourself organized, because what you don't want to do is you don't want to meet an investor and 10 minutes in start debating stuff you shouldn't be debating. Right? Have like normative paperwork, have things make sense, so that you can debate the big stuff. Are you truly different from the competition? How big is this market really? Tell me about the traction and what you're learning. Like that's the stuff we want to debate and discuss. Does that make sense? Sweet. Okay, let's talk a little bit about due diligence. So simply put, due diligence is the homework an investor does on your company to make that final decision. Right? So it's a cool term. Wow your friends at the next cocktail party, but at the end of the day, it's just doing the homework. Now I'm gonna play this out. Show of hands, how many people here have business degrees? Okay, how many people have technical degrees? How many people have master's degrees? Cool. How many people are from BC? How many people from Eastern Canada? Okay, so as you can see, there is a diversity of backgrounds in the room. And this is my first really important piece of advice for you, which is please don't get frustrated in due diligence, right? Because what you ask in due diligence is based on your background, your education, your experience, your context. Mine is based on mine, right? I have never seen a situation where 12 investors look at a deal and they're all like, okay, let's look at the financial forecast together first. No, if you meet Jim Fletcher in town, that's where he's going because he's a CFO by trade, right? But if you meet somebody else, they might be like, tell me about your growth strategy. Like I'm a marketing person, like, wow me with your marketing strategy, right? And so one thing that's very important to note is as you go through this, there's a set of guardrails upon which due diligence happens, but how individual investors play in there can be quite different. So the important part here is that what we want to do as a room is we're going to do two things. One is we're going to assume everybody's super picky. And the second thing is we're going to assume they all have some kind of a financial background. Because if we can satisfy those two things, you will literally satisfy every single investor out there. And then on those fun days where somebody like meets you 45 minutes into the first meeting and they're like, I'm in. You're like, yay, you know, but that'll be the one, you know, because everybody else will do their homework, right? There's a friend of mine in town who, no joke, they have a 100 item due diligence checklist for pre-seed for a 25K check. Kind of crazy, but that's their style, right? And so the important part is what we want to do is prepare for the most intensive so that everything else is easy street. Does that make sense? Great. So these are some of the key questions that people are asking. So tell me about the market. Now, there's a friend of mine in town. He's the only 3-time exit tech entrepreneur that I'm aware of. in Vancouver, like where he actually launched, led, exited. And he, as an investor, he said, look, he said, I actually don't look at the team first. He said, like, when I make my final decision, I'm investing in the team. But the way to get me from meeting 1 to 2 is the size of the market. And the reason is because at pre-seed, at this early stage that you guys are in, there's so many ways that things can go sideways. And so the premise in his particular case is he says, hey, I understand things can go sideways, things can work, things can't work. But if the market is big enough, it will afford you the time and the space to figure it out. But if it's a super tiny niche market and you make a couple of mistakes, you might never get out of it. So that's his thesis, right? So that's why I put that up first. Then, of course, yes, do I like you and your team? Is this product, solution, service exciting to me? I would say there is a subset of investors who are like stone cold objective. And that's awesome. But a lot of people just like, they're like, oh, that product you have, I personally experienced that problem. Like now I'm excited, right? Or like, I know a friend or a relative who, right? So there's a femtech company that actually our fund, sorry, you didn't hear this because we haven't announced it yet, but we're investing in a femtech company, women's health, and it's a hardware device. And the reason I got excited about it is because my mom personally experienced it. So when I heard the pitch, I'm like, I know exactly what you're talking about because I remember talking to my mom about that, right? So just to play it out. So that is a question that comes up often, not always, but often. Do you know your product, your market, and your competitors? Like, do you really understand it? And so a couple of things that I will know for everybody, we as entrepreneurs, there's certain things that, you know, we have rose-colored glasses on, right? Our company is our baby, right? And we love to push our company. I would love to do this, by the way. I think it would make for a great sitcom if all of us as entrepreneurs, we all got strollers, but instead of having a baby in there, there would be like a placard with our logo and we drive down the street and be like, look at my baby, you know? Because when a real baby goes down the street and people say, look at my baby, you're like, oh, so cute, whether they are or not, right? Because that's what we do. But when it's a startup, people have no qualms telling you your baby's ugly, right? And so it's really important to know this is where that comes into play, right? Is like, is your market appealing? Are you guys truly unique from the competition? And for most of us, our baby being beautiful is we actually think we're way better than the competition than we really are. So one trick that I want to share with everybody is everybody have who has a pitch deck? Trick question, I know. So how many of you guys have a slide for competition? Okay, so now coming out of here, you guys are going to create a second slide. Because that slide, typically speaking, you're saying, hey, this is how we're different from the competition. And my comment to you is you're probably not that good. And I'm not being flippant about that. You're probably just have rose-colored glasses. Create a second slide. This is actually where Ryan Holmes actually secured his first round with Hootsuite. Because people were like, how are you really different? He's like, no, like we're different this way. And you know, like investors like VC funds in Silicon Valley in New York are like, you know. So then what he did is he created a second slide. He's like, here's how we're different from the competition. Before they could roll their eyes, he clicked to the next slide. And he's like, and this is how we're going to be different 18 months from now. So he's like, I acknowledge that I think I'm different, more like I'm different from them today, but we're actually going to control our destiny and we're going to guarantee we're different from them in the next 18 months. And here's how. And then people were like, oh, interesting. Now let's talk about that. Let's talk about what's on slide 2, right? So just noting that sometimes you can actually make that work for you in that context. How are you charting a plan for growth? It is important to know, I am going to say this with much love. I'm born and raised Canadian. So when I say this, I'm a Canadian. So I'm looking in the mirror when I say this. Canadians are historically notoriously too conservative on growth. So I'm not saying that's the same for all of you, but I would challenge you to do this. One place that I often see entrepreneurs hiccup on growth is when you build your financial forecast. Some of you are good in that you've actually slotted in this round. So say you're targeting a 500K raise by like September 30th. So if I looked at your forecast, I would see October 1st, 500 grand hits the bank, right? So my encouragement to you is two things. One is challenge yourself. Have I actually put strategic lift in the other parts of the financial forecast based on that 500K hitting the bank at that time? But make sure you put the next round in the forecast too. And then the strategic lift that occurs with that. That's actually where I find is that even though you're thinking about raising, I find Canadians often, they kind of omit the logic argument of the step increase in cash. And ultimately the forecast is like a bootstrap forecast without the logic of like, actually I've raised capital. Does that make sense? Make sense? Yeah. By the way, sorry, this question never gets asked out loud. Right? I've never heard an investor say, hey, how can I trust you with my money? Like, they never say that.
I've heard it many times,
Nice.
but I'm in the mining industry.
Different. Yeah, and now you're coming this way, which is great.
Correct.
Yeah.
Tired of talking about drill results.
Good, good. So the interesting thing here is you now all know that is the unspoken, for the most part, the unspoken question. So my encouragement to all of you, hard recommendation, you will have a notebook. And you're gonna say, okay, great, I'm meeting with Keith for the first time, for the second time, for the third time, for the fourth time, I don't care how many times. You ask yourself the question, what information am I going to convey this investor in this meeting that will increase their trust in me? You have to ask yourself the explicit question and make sure you have an explicit answer. What am I conveying? Right? Is it, we've learned something from a deal, we've shortened our sales cycle, we've released a product on time or early, like what is it? You gotta give them something every time. Make sense? Cool. So just to note, investors are doing this due diligence because they're learning, confirming, and appraising, right? So they want to get to know and they want to confirm some things. And it is important to note, in each one of these, there's this interesting piece of human psychology that's happening, which is, in one level, due diligence is about increasing my excitement in the deal. And then the counterpoint to that is I'm looking for risks. Right? I'm looking for the skeletons in the closet. I'm looking for concerns. I'm looking for gaps. So, and it's a yin yang that we're playing. So whenever you hear an investor ask you a question about your company, what you want to do is actually take it in and say, like, is this a de-risk question or is this an excitement question? Try and get a handle on where this investor is going. Does that make sense? Yeah. And just so you guys know, sometimes you will get in a situation with an investor where they ask a bunch of risk questions. And I'm not saying something out of turn for all the female founders in the room. That's going to be the vast majority of questions you get. That's the bias that exists. A lot of great research out there. But the important part there is at a certain point in time, you actually do get a chance to just pause and ask the question. They're like, that's a great question. Listen, I've noticed these last three questions. You're really sensing there's risk in the deal. Tell me what you're thinking. Right? Like take a step back and a step up and say, hey, tell me where you're at. You know, and some people are like, you know what? I just don't think you're different from the competition, or like, I just don't think this market is big enough. Like, but it's a way to kind of reframe things so that you can kind of get going. Now, in terms of types of due diligence, there's business, technical, financial, and legal. And I know here for early stage investments, about 90% of the time is spent here because of course we don't have a lot of financials yet. And our legal tends to be relatively straightforward. Now, one thing I will note, and I know there's a couple of investors in the room who would probably shake their heads in agreement with me, but if there is one catch in legal, it's the cap table, right? And the ownership structure. And in particular, what I'm referring to is a lot of times companies start off and I don't know, like, let's say it's the five of us who start a company, right? And we're like, this is awesome. We're in a coffee shop at grade 5. And, you know, we're like, let's do this. And then like 3 weeks later, you're like, nah, you know, and then like 6 months later, I'm like, you know, I got to feed the kids, whatever. And so now it's 3. But the problem is the cap table still has 2 of us. And because it was all kumbaya in the beginning, we all have equal. So when you go to raise money, that's a problem. So my encouragement to all of you is if you guys have any, like, for example, like old founders that are no longer active in the business, but have more than 10% of the company, or if you have other investors that like don't make sense on the cap table, my encouragement to you is ask for help. I will tell you, I see this literally every single week, and there's 3 mainstream ways that you can solve that problem. It's not rocket science, it's entirely solvable, but you will need to solve it before raising money. Because if you have a founder who's no longer in the business that has 35% of the company, 95% of investors won't touch the company. Because for them, that's dead cap table. Does that make sense? Okay, so just noting that.
So the solution is to buy an audience or?
There's a few ways to do it. I don't want to dig into it in too many details. There's a couple of ways. One, of course, is to buy them out. Another way is actually to establish everything under a reverse vesting process. And then there's a third way, which is related to using, for lack of a better term, almost how can I put this? A time-based return of equity. Because the greatest reason why there's an issue around this is because you and I 50-50, we start something and then I leave. The challenge is that all co-founders think they were the reason the company's awesome, whether they were there for a day or 10 years. And so the key is that typically speaking, what happens is if you come to me and say, Keith, I'll buy you out, I'm like, feel like I'm gonna get screwed here. Feel like you got a deal to sell the company for $250 million tomorrow, and I don't know that. So typically speaking, you want to incorporate a time-based element such that if you did sell the company tomorrow for $100 million, we would win appropriately. But if it happens 3 years from now, where I haven't been involved for 3 years and you've been driving the bus, then you win the majority of that. Does that make sense? Go ahead.
That we're doing corporate structure next week at Baskin, so we'll dig more into that.
And Jeff Petler is doing that. So yeah, so that'll actually be a great session. Go ahead.
So my question was just around for the early stage companies. Have you seen much done in terms of management and papering up the founders' shares and those kinds of structures? I haven't seen a lot of that in the early stage stuff.
Like where they've, so sorry, the question,
Like, is there much help in that regard in terms of, as opposed to just a, 50-50 or a, 33, like, is there, I haven't seen much work done.
like proper work, right?
Yes.
Okay, so for the people online, the question is, have I seen where a co-founding team along with probably a law firm have actually done a real like fulsome job of figuring out the cap table at inception or right like closely thereafter?
What kind of tools are?
Yeah, and so what I would say to you is, I'm gonna date myself, but back in like 2009 to 2012, there was a big movement at the time for what was called reverse vesting. And so the premise was to try and solve this dead co-founder problem. The premise was that, let's say the 3 of us are co-founders. All of our shares would go into the corporate treasury. We would own 0. And then what would happen is over time, we would earn up to third, depending on how long we stay in the role that we play. So there actually was this very formalized approach. It created a lot of divisiveness in the market. And the reason, like for investors, investors were kind of like, look, just make it easier for everybody. Because if you have to individually negotiate like ad hoc afterwards, it can be very difficult, So investors were like, just make it easier for yourself. And entrepreneurs were like, whoa. Like, are you telling me like Thursday morning at 8 a.m. I'm back to 0? So what I will tell you is it was a movement for about 3 years and then it tailed off. So what I would say though, as the I guess evolution of that is that a couple of things have happened. One is the proliferation of common docs, which spans both financing as well as sorry.
Okay,
For those online, it's coming back.
Yeah,
It'll come back.
We'll reset while you're talking.
Yeah.
Great.
Don't worry.
It'll
The
come.
evolution of what, doc?
So common docs. So common docs actually, it's a combination of things. So common docs is like shareholders agreement, corporation docs. and then template financing agreements, like template safe agreements and convertible note agreements, term sheets, et cetera. And now, the firms that I know for sure that have common docs would include Fasken, Osler, Inc. I think DLA Piper has some, and so the benefit is that even though maybe there hasn't been a formality of like discussion, at least some of the comment docs and some of the kind of thought processes out there to like give people a grounding. Yeah, so we could wax poetic on that. Jeff is gonna cover the legal structure part of it next week. And I'm happy to kind of chat about it offline as well. Go ahead.
Name is Maria, company is Trillquest. Can you dig a little bit more into the de-risking questions for the pre-seed and seed companies? And maybe you have recommendations of the way to answer it, because you technically don't have the historicals to prove within that context. How do you approach them?
Yeah, so the question for those online is, what are some of those de-risking questions that come up at pre-seed and seed stage and how to handle them? So there's a few components that come into play. So at least from my own perspective, when I'm looking at deals, I'm looking at competitive framing, I'm looking at the breadth and depth of the team, I'm looking at your progress are probably the big three areas we're gonna start to poke around hard, looking for risk areas. So I'm speaking from my own framing. I will note that for any of you here, anybody here have patent applications? Right, okay, so a number of you have patent applications, so for some of you, you've done that maybe as kind of like a matter of course. For some of you, it might be a little bit more core to your strategy. And so if you have an IP strategy in your business, then that's gonna definitely be an area of risk and de-risk. And I think typically speaking, what investors are looking for at pre-seed stage is they're looking to see like, do you understand your market? Do you understand the industry? Do you understand how it works? Do you understand how theoretically you should be going to market? Right? Those are some of the big questions. Do you understand the competitive landscape? Right? When you get into seed implies you've got some momentum, right? Now, for some of you, you have a relatively light touch product, you're already in the market, you're in revenue. Great, you're what we call an execution play, right? If you're in women's health femtech, it could take you 5 years to get that product to market, right? So sometimes the seed round is more like, you know, I've got regulatory approval in the US, but not yet in Canada, blah, 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 right? Like, so it varies, progress varies. But at that point in time, people are really gonna start to hone in on like, how, like, dig into your progress. Like, how have you been creating momentum? Have you been able to sustain momentum and traction? You know, should be advanced clarity on competitive framing. There should be advanced clarity on your path to market and the steps that you're taking, right? And so one example that I'll give is what I will call the shape of the funnel. How many people here are B2B? Business to business? Yeah, okay. So for business to business specifically, one of the things you want to nail early is what we call the shape of the sales funnel, right? So in other words, you want to convey very quickly that you understand for your industry, this is the shape of the funnel. These are the steps in the sales funnel. These are the probabilities at each stage, and you need to convey how you're filling those steps. The final piece, which is actually most important of all, is, look, I've got companies that are flowing through the shape of the funnel here, and this is what we've learned. So I'll give everybody an example. There's a company in town called Spread at Work, or at least used to be in town called Spread at Work. And Spread at Work was acquired by TELUS. That's why I'm saying sort of in town, not anymore. It's a part of TELUS now. When they first started their first deal, a health and wellness platform for businesses, first deal took 17 months from first call to close. So when they, you know, with a lot of pride, they went out to investors and they're like, we got a customer, and investors are like, great, you know, so they started talking, and they're like, tell me what the shape of the funnel, and they were like, this, and then this, and then this, and it's totally awesome, and we've got companies up here, and we first customer, and so then some smarty pants investor was like, so how long did that take? 17 months, and that was the end of the conversation, because they're like, you don't have a business in 17 months. I mean, if you're selling $15 million mining equipment to a mine, that's different, right? But this is like $30 a user per month, you know? And so they're like, no, you don't have a business. But to their credit, they were like, they heard it. And so what they did is they went back to the drawing board and they're like, how do we get 17 months down? And so they actually recast their go-to-market strategy. You can get into the details later if you're curious, but they literally went from 17 months to 4 months in 6. So then 6 months later, they went back to the market and they're like, shape of the funnel. And people were like, so how long? And they're like, 4 months. They were like, great, I'll invest. Like, transform the business. So any of you for B2B around this, especially at seed stage, you need to give me that. Now, if you're pre-seed, you can still show me the shape of the funnel, but you might be showing me like, here's people at the top of the funnel. These people have seen demos. And then you get into memorandum of understanding, MOUs, then LOIs, pilots, paid pilots, pre-buy, right? So even if you're pre-launch, you guys can show all of that, right? Who's direct to consumer? Anybody direct to consumer? So a couple of you, great. So the benefit for you is your funnel's the marketing funnel, right? So in your particular case, it's like, here's the shape of my marketing funnel. Why do you know it's the shape of your marketing funnel? Because I've looked at other businesses in my industry. This is how the shape of the funnel is. This is how we're going to work that funnel. This is how we're going to optimize it. Hypothesis first, and then you start to prove the hypothesis. So I'll give everybody an example. Hootsuite, even though it was business customers, a lot of those, you know, were like bloggers and like individual people. So sort of consumer-like, right? And so in that model, they had this like freemium structure. So they said, okay, for this many people who hit the webpage, they're going to be like, this many people are going to download it. This many people are going to become active. So they, you know, they had their probability conversions, right? And then from there, then they said, okay, and this many of the free ones will convert to pay. So if you guys want the stats at the time, the market industry average in late 2009 for freemium was 2.4%. So when Ryan pitched it, he was like, hey, when we launch our for pay, we think that last piece is going to be 1.8%. We know the market is 2.4, but because we're just launching, we have the humility to know we're not going to be optimized right away. So we're going to start at 1.8, and then we think at 6 months we'll hit the market average. But then 6 months later, we're going to be at 2.7, and here's why. So what he did is he said, we did our homework, so we know what the industry average is. Second, we have the humility to know we're not going to be optimized day one. Third, we have the moxie to believe that we're going to exceed the market. Now, if y'all wonder why they became a unicorn, it's because the industry average was 2.4. When they launched freemium, they got it just right. And they converted at 9.8. So if you want to know how that happened, that's how it happened. They were converting from free to pay at 4x the industry average, right? So, but notice what I did there. And D2C, for anybody in this room who's D2C, like you guys need to know in the city of Vancouver, you've got the uphill battle. The vast majority of investors, 90% of investors in this town are B2B. So if you're going to be like, hey, we're direct-to-consumer companies, they're all going to start to glaze over. The way that you hook them is you're like, this is my inbound marketing funnel. This is my conversion rate funnel. This is how we're going to optimize. These numbers will set us free. That's how you make it go from voodoo to math, and then they can all embrace it, or at least theoretically. Make sense? Yeah. Great, good. So data rooms. I do want to talk about this. What's very important in this mix, so data room, simply put, is your Google Drive folder, your Dropbox folder, where you store all this stuff that they want to do homework on, right? So one thing I was going to tell you guys at the end, I'm kind of like half talking about it. So you guys are going to get access to our learning portal. And so in there, there's 12 modules, lots of videos, lots of tools, lots of resources. There's an entire section exactly on how to structure this. It's not rocket science. You guys will get an email invitation, go in there, just copy and paste. It's just like set up these folder structures, etc. How many people here love data and love to track? Right? Okay, so here's your tip, orange docs. So the color orange docs, all one word, DOX. So you use that for your data room. It allows you to track everything an investor does in your data room. what pages they linger on, when they flip, where do they, like everything. It's awesome. Right? So use that as a framework. Orange Docs, check it out. But the important part is that, remember we talked about a trust-based relationship? So if you guys want to guaranteed be in the top 5% of founders with any investor, you have a first meeting, right? I'm pitching you, and then you say, hey, Keith, this has been awesome. I'd love to continue the conversation. Send me a copy of your deck. You're not gonna do that. Here's what you're gonna do. You're gonna send me an email and you're gonna say, Keith, thanks for your time. I've attached a copy of the deck. I've also attached a video of me pitching the deck. And here's a link to my data room. Call me if you have any questions. We'd love to talk it out. So what have I done by doing that?
Anticipated their needs, let them do it on their own time.
Yeah, and I've told them emphatically, I am ready. I have done my homework, I've done my prep, and I guarantee that 95% of other entrepreneurs have not done that. So you're automatically in the top 5% by doing that. It does not mean you need to have 100 items in your data room, just to be clear. In our LMS, there's about 23 things that you kind of have to have in there day one, but it's not 100, right? And some of them you already got, like your pitch deck. Now, why did I say include a copy of the deck, but then also a link to a recording of you pitching it? Why did I say that? Any guesses?
Connection.
Connection? Anybody else?
Founder personality.
Founder personality, right? So here's the big reason. Investors are notorious forwarding it. Right? I see your pitch and I'm like, Prashant's gonna love this. And then what I do is I just hit forward, enter his name, and I'm like, Prashant, check it out. But what is your deck? It's a highly visual, non-word based presentation. Prashant wasn't in the room. He doesn't have the context. He doesn't have a clue of what it is. I just said, it's cool. Check it out. Right? Instead, he gets a link to a video, and in our modern YouTube, TikTok world, right? 3.5 minute video of you pitching it. Then he just gets to sit back. He gets to watch it while drinking his favorite cocktail. And he's like, not only does he have the context, he has the founder personality. He understands everything about it. Right? So that's the reason you do it. Investors are notorious for forwarding decks to friends, right? And if they don't have the context, they read it and they're like, they get it, but they don't get it. But like, maybe in the deck, like you said, hey, like in a presentation, you're like, Keith, I'm doing this because I personally experienced it. But maybe you didn't write that in the deck. So then I don't know. Like maybe you're just doing it because you're a capitalist, right?
And I would say that very importantly, they're seeing it and the source is a trusted source.
Trusted source.
That's gold.
Yeah, exactly. So I think that's key. So I just want to make sure that we have that in mind. So it is important to note these are the broad-based categories. We have corporate information, including like shareholders agreements, corporation docs, cap table, right? Customer information. So customer information for the D2C guys, like this is like demographic profiling, like who's your ideal customer, how are you going to reach them? For all you B2B guys, like you might go so far as having like prospect list, customer list. You might have, if you're in the market, you might actually have like a doc with testimonials, case studies, etc. Always powerful. One thing that I would encourage, this applies to a small subset of people in the room. But for some of you, you have very trusted business customers already. If you do, tell them you're raising and ask them if they would be willing to take a reference call from an investor. Wait until you know they're warmed up. But if you can offer that when the time comes, it's hugely powerful. Okay. Financials. So it is important to know financials is typically speaking at the pre-seed stage. I would say probably a minimum 2-year forecast. 5-year forecast is probably going to feel a little bit like overload on a pre-seed, but if you're already in the market, maybe when you get into seed, you're absolutely going to need a 5-year forecast. Now in the perfect world, you would have 3 versions. So you have like, remember we were talking earlier about raising 500K. So your like base case is like, here's my pre-seed and I'm raising 500K, which is inserted here. Great. So you have the base case and then you should have a worst case and a best case. So if you said, Keith, great, but like, where do I start? So the simplest way to think about it is the worst case scenario is you raise half. And then the best case scenario is you raise double. Now, I'm using that as a surrogate. You might say actually revenue is double, or like, like there's lots of ways to make the double happen, but it's like half or double. And there's a couple of reasons why you do that. One is it shows an investor that you've actually been looking at best and worst case scenarios. Here's the bigger reason why you do this. It's hard to raise money at any point in time. Now it's harder. Like by the way, like you guys need to hear this. This is not the fall of 2001 hard or Q1, Q2, 2002. Like that was like the desert. That was a whole other world. But it's still challenging to raise. And so because of that, you might end up in a situation where you've been telling the market that you're raising up to 500K. You might 7 months from now get to a place where you're stuck at 350. Because you have already built and you have socialized and they have seen the doomsday scenario and they know you can get from A to B with 250, then you actually have now an option where you can go to investors and say, you know what? This is dragging out. Market's terrible. Blame Trump. I don't care. Do whatever you want to do. But just say, you know what? You guys have seen my worst case scenario. 350 is enough. I'm going to close it right now. I'm going to run for 8 or 9 or 12 months, and then I'm going to raise again at a higher valuation. So you're actually teeing up so that you can close on a worst case scenario. Because if all you've ever done is tell people that you got champagne and roses and you're raising $1 million and you get to 600, and then you're like, yeah, I was just kidding. There's no champagne and roses. The credibility is hard, right? So have those scenarios built out. It's a little bit of pain now versus pain later. Does that make sense? Go ahead.
Question is, the way you're talking, it sounds as though we're raising for a period of time, but then stop raising. There's a close and then execution, and then another raise for another.
Great. So the question here for everybody is, am I implying that you should have a start date and an end date to a round? There's a period of time that passes, then a next start date and an end date, or do you raise continuously?
Mm-hmm.
So the short answer is yes and no. Sorry. So in the first 5 years of being a startup entrepreneur, yes, you're raising every day.
Mm-hmm.
But what happens is your relationship building raising.
Right.
And then from time to time, you're like, and now for a round, and now for a round. And those rounds have, target, start date, and end date. Now, here's the important part. Everybody knows the start date. You do not specify the end date up front.
Hmm.
Why do we not specify the end date up front? Any guesses? Human nature, we
You wait to the last.
late procrastinate. Why do today? Or I can put off till tomorrow. So if you said to me, hey, Keith, like I'm raising around, cool. And then you happen to blurt out, yeah, and I'm going to close it on June 30th. I'm like, great. I diarized June 29th at 4 p.m.
Mm-hmm.
And then, great. But there's a second thing that goes along with that, because you said I'm raising 500,000 by June 30th. So when I call you at 4 p.m. on June 29th, I'm like, so how much have you raised? Because if you're like, yeah, I'm going to have to push back the date. That's a problem, right? And the reason is because for better or worse, I'm judging you, right? You said 500K June 30th. If you don't hit it, I'm now going to start to question you. So here's the trick. So you're like, Keith, I really want to close this thing by like October 15th, right? I'm like, great. So if I push you today and I'm like, you're like, hey, I'm going to start to raise around next month. Really looking forward to this. And I'm like, great. When are you going to close it? And you're like, Q4. Now I got a 90-day buffer to get it done, right? It could be October 1st. It could be, New Year's Eve. It could be anywhere in between. So what you do is if somebody pushes you, know the quarter that you're aiming for, right? You're like, yeah, I'm aiming for Q4, which is code for you're just getting started. You have no freaking idea when you're going to close it, but I respect you for knowing that you're kind of aiming at a certain spot. The second thing is you don't tell me you're raising 500K. You say I'm raising up to 500K, right? Because if you get to 425, great. So true story, I've told this story many, many times. We had a company that we knew, we were working with in spring, they were trying to raise 500K. And he told everybody, he's like, I'm raising 500K by this date. And so then the time came and he got the 485. He was 15K short on 500. So he sent an email to all the investors. He's like, hey, listen, like deadline's coming. So yeah, I'm at 485. I don't have the last 15. So I'm just gonna call it. And I'm not joking. In 3 weeks, his 485 went to 0. This fascinating like example of human psychology. People were like, well, why don't you put it in the 15K yourself? What do you mean you can't find another 15K? Hold on a second. Like, and then people are like, well, if you can't convince another investor to throw in 15K, what are they seeing that I'm not seeing? Like literally, that was the circular argument that people started to get into, and it just spiraled right down the toilet. So my encouragement to you guys is remember psychology. Remember we talked about variables, right? So there's certain things that early on, we don't want to like pin ourselves in a corner and say exactly 500K, exactly June 30th, right? So there's tricks on how we get to close. But, you know, when we're kicking off the round, we need to keep a level of vagueness enough so that there's room. Because if you say, hey, Keith, I'm raising up to 500, I'm like, geez, Carl, if I were you, I'd raise $1 million. Then you'd be like, tell me why you think that, right? And then you talk to Prashant. Prashant's like, I think 650. So part of the first 30, 45 days is just finding out what everybody like socializing the round, getting the crowd to kind of tell you what they think the right round is for you. And then you'll have to decide. Gray area management decision.
Keith, the trick in the mining industry is you make your amount that you need, but you advertise it in a news release as lower. So then you can say you've oversubscribed and it looks like you've done better.
Okay, so I'm gonna touch on this because this is something that some of you will have heard. I think it actually was just in the news yesterday or today, Reusables. Company here in town, awesome circular economy company. I think they described it as an oversubscribed 2.6 million. So what an oversubscribed means is I've told everybody I'm raising 2, they get to 2.6. That means they've raised more than what they forecasted, ergo oversubscribed. Oversubscribe from a marketing or a brand perspective, it's all win, right? When people read a press release and Carl's like, hey, we oversubscribe. You're like, okay, like there's gotta be something good happening here, right? And a lot of the investors who missed that round, they like immediately, they're like, call me as soon as you're raising the next round. You know, like it's FOMO, it's like literally the very definition. So it is important to note that when I go through this process and not that I'm guaranteeing myself oversubscribe, but I will tell you guys, like, if you want to raise $1 million, like $1 million, it's actually really not a lot of money, and it's a shit ton of money. Technical term. It's a lot of money all at the same time, right? And so sometimes like getting to the million can be hard. So sometimes what I have done in the past with my own companies and with others is to say, tell everybody you're raising 800. And just know that you can oversubscribe, because if you raise, say, 400 on 800, now you're already 50% of the way there. But if it's 400 on $1 million, you're only 40% of the way there. Psychology of momentum.
I have an example of that.
Right.
I did an IPO on a gold company.
Yeah.
Potentially, we made it 750. And so we had to cut people back.
Yeah.
And so there was so much FOMO that after we listed,
Yeah.
we were able to do another financing on the public side. And it was bigger than what we originally intended. So we
Yeah.
raised another 6 when it would have been much lower on the second round.
So I do like, and that's a great example. And I do want to highlight to everybody that if your target is $1 million and you're really like, you know what, I really don't want less, then you're not going to undercut it. You're going to be like, no, like my target's $1 million. But if you're like, I'd love $1 million, but I could do with 750, then you can tell the market 800. And then to your point, if you get to the full number and you have this FOMO and people crowding, there's this great thing that happens, which is you get to be picky, right? You don't have to take the money, and you can take the best money. And when I mean best money, which is the money that's actually strategically valuable for you.
Yeah.
Investors who have industry experience, business model experience, they've got a great network of customers and partners, maybe a great network of other investors, right? Like, so the benefit is we get to be a little bit pickier in this mix. If you guys want to know the best way to do it, there's a company in town, called Social Nature. Amazing company, Analia Krebs is the CEO, it's her fourth startup. And when she did the speaking of picky, right, she's like, okay, I'm gonna raise, her target was 1.5 million. She told everybody 1 million because she knew she could settle at 1 million so long as it was good money, right? So she went into the market, this is back in 2016, her first round. And so she went out to the market and she's like, okay, I'm raising. Now you guys need to hear this. She spent no less than, I'm gonna say 3 weeks. She can confirm that, but it was about 3 weeks where she just did homework after homework after homework on investors. Who knows the industry, who knows the business model, who's been there, who's done that, like everything. She took all that time. Total number of investors she reached out to, 16. Total number of investors closed, 13. So she's like, I don't have the time to talk to 120 investors. So now, but you need to know, like literally spending 120 hours up front, paying now, paying later, right? The average company will talk to a minimum of 65 investors. So who's doing it the right way, right? So don't be shy to be super laser focused. And I gotta tell you, like Crunchbase, PitchBook, LinkedIn, like there's no reason why you don't spend the time to find out those people who totally exactly get what you're doing, right? So, because the converse, if you guys want to play it out, go into the coffee shop and start asking. You investor, you never know. If you guys ever hear an entrepreneur say to you like, hey, I'm gonna be pitching this guy, and you're like, is he really a fit? And you're like, I never know. If another another entrepreneur says to you, I never know, walk away from them and run. You know, because like entrepreneurs who are like, you never know, they're the ones who talk to 120 investors, they burn out, they don't raise. Don't do that. Please don't do that. So best ways to share. We talked about this. I mentioned Orange Stocks. Carta is another example of trackable software. I'm partial to Orange Stocks because it's a Vancouver entrepreneur who built it. So buy Canadian. Share the folder early. As I mentioned, get into the top 5%. Now, here's the other thing that gets you into the top 5%. Every time an investor asks you a question, put it in an FAQ. Have the FAQ being the standalone doc at the top of the folder structure so that when you send that email and you're like, hey, Keith, like, here's the deck, here's the video, here's my data room, and here's a link to the FAQ for all the questions that other investors have asked so far. Awesome. 2 things. One is you've got momentum, right? Because other investors are asking. Second, you've got answers to those questions, right? Third, you're being super efficient with your time, so you don't actually have to repeat all of those answers over and over again, right? Because often questions are very common. NDA, I do want to talk about this very briefly, non-disclosure agreement. The original history of angel investing and venture capital is no NDAs. So if you go back into the 70s, like even before, frankly, but like, let's say 70s, 80s, and 90s, the whole premise was, I'm an investor, I'm looking at hundreds of deals, right? And so you're gonna send me your deck. This guy sent me his deck. He's sort of like in and around your world, but like, if I sign an NDA with everybody, then like, I can't look at deals. So I just will not sign an NDA, period. So I wanna make sure that we talk about this because I would argue that that's probably still the vast majority of investors are still in that camp. Their concern is that if they sign an NDA, no matter how loose it is, that if I look at your company and then I look at his company, I invest in his company, and you're like, whoa, you signed an NDA, now I'm gonna sue you, right? So most investors will run for the hills when you put an NDA in place. The reason I'm sharing that is because there is a movement to say, no, you need to be asking for NDAs up front. So I'm gonna give you maybe a couple of perspectives on this, my own personal perspectives. So personally, and I'm saying this in part because, again, like my first 3 companies were tech companies, so I've been in your shoes with much humility. And so the reality is we all think we're awesome and we all think we've got the secret sauce. And so my comment is like, it would be great. Like I would bet any of you guys cocktails. I will get hammered tonight. Because I'll be like, you'll be like, hey, Keith, I'm really unique, like you need an NDA, and I'm like, okay, I'm gonna open up a browser and I'm gonna open up a page called Google. And I'm gonna prove to you in 15 minutes or less, there's at least 16 other people doing exactly what you're doing, and then you're gonna buy me a drink. And I guarantee it'll apply to everybody. The chance of somebody in this room having a pure play new idea is so low. It's shades of gray, sometimes important shades of gray, but it's shades of gray. So my comment is, historically, the companies that I've seen who have demanded NDAs are the people who literally are carbon copies of other stuff out there. Like they're the people who are absolutely the least in need of an NDA. Now, there is a second camp of people, strong IP plays. So I asked earlier, some of you guys have patent applications. So it is important to note that with patent applications, once they're published, if I'm like, hey, technical due diligence, I would send them a link to the USPTO and be like, here's all of our patents, they're published. Fill your boots, right? And then they're like, no, can I see your source code? NDA, right? So once you go from what is public domain to private domain, when you have deep IP, then it's fair game to say, hey, all this folder structure that we had, right? All this stuff is freely available, but there's a portion of this that is behind the paywall, which is like, if you want to do that deep technical due diligence, you give me a term sheet and I'll give it to you, or sign an NDA. Does that make sense? Okay. Great. Okay, so we talked about all this stuff. So how many people are actively raising? Okay, a handful of you. What do you wish you had started earlier in your process, in your prep? Any, just would love your perspective. Investor outreach. So for those online, I asked the question, what do you wish you had started earlier? Investor outreach. So Alexander, okay. Alexander raises such a critical point. Your ideal time to reach out to investors is when you don't need the money, right? So Carl, I was saying earlier, you might be saying, hey, I might want to raise in Q4. So now's the time to start talking to investors. It's a relationship game. You're building trust. So the way that you would reach out, hypothetically, you would reach out to me, Spring Impact Capital Fund, you're a clean tech play or a health tech play, and you're like, Keith, I'm a clean tech company or I'm a health tech company. And you know, we've got great things happening in our company. Thinking about raising in Q4, I'd love to grab a coffee to get some of your feedback now and get your advice. Awesome. Like start to build rapport because there's no pressure at that point. And for us, like we understand that's like, I spend the time because I know I'm filling the top of the funnel, but there's no pressure to make a decision, right? It's always challenging for an investor when you call them and you're like, hey, Keith, like you want to talk? Like I'm closing my round on April 30th. You got 5 days, you know? And so, you know, it's, you have to create space for relationship to build. Sometimes, of course, FOMO, you can do that, but like just to play it out. Go ahead.
How many levels, how many data rooms should you have? Because you said for the NDAs, if you have source storage of IPs, that should be another paywall. What are how many levels? Level 1, 2 levels, 3 levels?
It's a good question. So the question for the people online is how many data rooms should I have? So my personal preference is to have one data room, right? And then what I do is I restrict folder access here. So like say there's a macro like product folder, and then there's some basic information, and then there's like a subfolder, which is like, I don't call it deep tech due diligence or whatever. And the reason I like to put it there is because this is a sales process.
FOMO.
Yeah, so they're like, hey, Keith, I can't get into this. And I'm like, well, yeah, that's the proprietary stuff. And so all the publicly available stuff is in the top. But if you want the proprietary stuff, that's on the other side of a term sheet, right? So I use it as a sales technique. Single data room, restrict the access on that folder. Does that make sense?
Yeah, would you put revenue model as well in there?
No. Personal opinion, revenue models are universal truth. Geez, I don't know. I feel like I should, Angie and I should talk about this. In 20 years of doing this, maybe I've seen 2 companies that have like innovated so radically on like revenue model that technically it was hidden. But remember, you guys are pre-seed, so I think you're full of it anyways. Like, no offense. You know what I mean? Like, so I think that's really important. Now, remember I was talking about Hootsuite? When Hootsuite raised its first round, which was a $2 million round, they hadn't actually turned on the revenue line yet. But they had these like ideas about how to optimize on freemium. When they raised their next round, which was 15 months later, that was totally blocked off. Because nobody was pulling it off. Right, but they had the proof, so that people were like, they weren't like, oh, you're full of it, like, they're like, oh, that's the folder I want, and then they're like, sure, term sheet. You know, and then open it up. So typically speaking, for me, the only thing that goes behind a paywall is, maybe two things, actually. One is the tech, like the deep tech. The other one is a customer contact list. Especially if you get into seed round, like, cause some people will be like, hey, I want your customer contact list, and you're like, great, absolutely, after a term sheet. It's there, you can see the folders there whenever you're ready for it, you know.
Dictionary,
What was that?
dictionary,
Pictionary?
dictionary,
Dictionary,
Term sheet.
paywall.
What's a paywall?
paywall, term sheet, both. Paywall means that, there's certain things that are available to you freely, and then in order to get advanced features, you have to pay a premium. Very common in direct to consumer, right? Yeah, I'm trying to think. I mean, Hootsuite is an easy one here where like there's a free version and then the next version up is $12.95. How many people here love to be heckled and berated by Duolingo? Right? So Duolingo is an example of paywall, right? There's a freemium version and they hound you to pay. And then the moment that you go up a level, which I did 6 months ago, immediately they started hounding me for the next level. They're like, well, now you're at super, but you could be, you know, and so that's paywall, right? So there's some stuff that's freely available and other stuff is for pay. In this case, the investor is not paying you $12.95 a month, they're giving you a term sheet. Now to term sheet definition. So when you are taking investment from an investor at the time when they're like, let's do this, I'm gonna give you 100K or 50K or whatever the number is. And you're like, great, you're gonna send them paperwork. And then they're gonna review it, they're gonna sign it, and then they're gonna wire you the money, right? So that paperwork is according to, remember at the beginning of this conversation, we talked about common shares, preferred shares, convertible notes, safe. So if it's a convertible note or a safe, it's a convertible note agreement or a safe agreement. That is the sum total of the agreement. If you go to like a price round, like the common share round or pref round, you get like a share subscription agreement and a few other documents that will go with that, sometimes a ROFR agreement or right of first refusal agreement, et cetera. So you'll get, so that's what we call the paperwork, like that's the core paperwork. When I say go, you send me that, I sign, wire you the money. So there's a step that comes before that in many, but not all cases, which is called the term sheet. So the term sheet is a document typically 2 to 3 pages in length. I've seen it as long as 6. One case or 2 cases, I saw it a single page, but it's literally a summary of the terms that are found in the formal documents. Because the formal documents sometimes can stretch to like 37 pages. So the premise is you send me a 2, 3 page, 4 page doc that's like, here's the high level terms that you'll find in the paperwork. So the reason that you send that is because first, it's an easy way to share a summary of the terms. Second, it's a way to kind of create a bit of a gate in your sales process to say, if you send me the term sheet and I say, this is great, send me the paperwork. So you're moving me from one step of the funnel to the next, right? But here's the absolutely critical thing for you guys all to know. A term sheet is the fundraising term for a Valentine's card. And why do I say that? Because a term sheet is not legally binding in any way, shape, or form. So when you send me the term sheet and you're like, Keith, here's my terms. If I say to you, and you guys need to remember this, A, your company is what? It's your baby. Second, what do you need? Money, right? So what happens is I say to you, I like your baby's cute. Send me the paperwork. All you guys hear is Keith wants to invest. That's literally all you hear. Like, Keith's gonna send me the money. No. I said Valentine's card, right? That's all I said. Send me your Valentine's card. And then I'm gonna admire it. Like literally, that's all it is, right? And so
And
the
it's not part of
important,
the process at all?
it is a part of the process.
It is, but there's no signature on it that makes it binding in any way?
No.
Okay.
I mean, I have seen some with signatures, but it actually doesn't bind you to commit.
Okay.
Agreed term sheet,
What's that?
signed or agreed term sheet. It's not binding, but it shows he agreed.
It only shows that I enjoyed our first date. Like it literally, like you guys need to hear this. It is not binding in any way, shape or form. And so the reason that this is important is because first, I want to make sure you guys go into this process with clarity. Be pragmatic. Don't be optimistic. Just because I asked for the term sheet doesn't mean I'm going to invest. It just means I've asked for the term sheet. So there's two things. One is use it in your favor, and there's a couple of ways to do that. Okay, so first, if I say to you, hey, send me your term sheet, and you're like, cool, I could do that. But given that it's not legally binding, I could just send you the paperwork and you can see all the details. I'll just summarize it in a few bullet points in my email. So now that's a test close. Right? Because then I might be like, yeah, good point, just send me that. Then be like, no, I really need to see the term sheet. So now what I'm signaling to you is a couple of things. And now for you to figure out, A, am I not yet convinced? Second, do I still feel the need to do more due diligence? Third, actually, am I just a follower and not a leader? Right? Remember, sub 5% of investors lead, 95% follow. Right? So sometimes when you do that, if I'm like, hey, send me the term sheet, and I'll be like, great, and then you send them the paperwork, and then I'm like, well, where's the term sheet? And you're like, well, it's not legally binding anyways, just go through, like, here's the details, I've summarized it for you. So sometimes I literally, like, the first thing that comes out of the investor's mouth is like, well, so who's leading this round? So now it signals to me where they are, right? Or they might say, well, no, I'm not ready yet. Like, so the important part is that if somebody asks you for the term sheet, and you're not being prickly about it, you're just saying, thanks, I'm excited that you want to see that. Given that it's not legally binding, I can send you the paperwork and summarize the terms in the email. Would that be okay? Because then I'm like, you know what? I really need to see that. And then you're like, tell me why. Like, do you have more questions? Is it, is it your standard process? Like, ask, right? And you guys need to know part of the reason is there is a subset of Canadian investors who ask you for the term sheet because they're actually giving you a Canadian no. They're like, they don't want to say no. They're like, yeah, send me the term sheet. And they're like, but do you really need to see that term sheet? Right? And so sometimes you push. Or they're like, well, no, like I'm still going to need to do more due diligence. And you're like, that's awesome. Tell me some of the areas you think you might want to dig in on. And then that way I can kind of plan accordingly and make sure that I'm able to answer your questions fully. Does that make sense? So the important part here is a term sheet is a reasonably standard part of the process. Not all investors ask for it, but many do, right? Second, it's not legally binding in any way. So it's a signal to you, but it's not a concrete move to the next step of the funnel. So then it signals to you that you need to ask more questions to get to clarity about where they stand today. Is it a Canadian no? Do they have outstanding concerns? Are they just naturally a follower? Where are they? Right? Because that's our goal is as we walk through this, we just want to understand where they are in the mix. Does that make sense? Cool. Go ahead.
What is the next step in the funnel between the final signature and the term sheet? Is there one?
So term sheet for me can slot in a couple of places in the funnel. Actually, I think I might be, hold on. I know I'm getting to it. It's probably a little bit too far along. Okay. To make a long story short, there's like first meeting, from first meeting, your, interest established, right? And then once interest is established, now they're starting due diligence. So that's like the next step of the process. They're starting to dig in. And then typically speaking, there's a moment in time where you get to a verbal commit. Now, sometimes they're like, sure, I'm in for 100K or I'm in for 50K, send me the term sheet. Or they might actually ask for the term sheet before they give you the commit. So it does depend on the individual investor. So it's typically in and around verbal commit. Now, not to deflate you guys, again, it's about managing the sales process. If I say to you, I'm in for 50K, verbal commit, what is the probability to close? Any guesses? 10%. 10%, anybody else? 50, 30. Okay, so winner at the back of the room, 50. Right? So if I say verbal, that's a good jump in the funnel, but there's a long way to go. Because sometimes people say yes, but they still want to do a bit more due diligence. Sometimes they say yes, but they say yes on the condition you find a lead, right? A lead investor. And then the other one is that in this particular case, if you're talking to individual angels, what are angel investors? They're human beings, hopes and fears and dreams, right? So I have seen people give verbal commit and walk away because they lost interest, they renovated the bathroom, inoperable brain tumor, divorce, climbed a mountain in Nepal, like you name it, like life, they're individuals, shit happens, right? And so the important part is that happens. Now with VCs, it's a different animal, right? If they say they're in, they sign a term sheet, usually one of two things will happen between term sheet and the paperwork if they walk away. One is there's something that happens in the business where they lose confidence in the deal. And that could be like you lose a major customer or some skeleton comes out of the closet, right? Or they meet his company and they're like, that one instead, right? So just know that it tends to be fairly narrow on the choices there, okay? Cool, it's a great question. I am gonna touch on the sales funnel briefly.
I need to wait down. Sorry, give it a second.
There it is, all right. And I might maybe,
Sorry, yeah, it's gonna take a quick second here.
thank you, appreciate it. For those online, we're just getting everything warmed back up again.
Okay.
Awesome, thank you.
Yeah.
So, getting started, so I just want to make sure that you guys remember, it's not just about the money. Investors are not ATMs. I wish they were. Wouldn't it be great to walk up to a person and just like type in convertible note 50K, you hit withdraw? Wouldn't that be awesome? But think about the kind of relationships that you want to have, right? Like who understands your business, who can support you. And I would say now, like circa 2025 versus say 2005, right? Like 20 years hence, there's a lot of people who've been successful in businesses, exited, they're investors now. So you can really draw on that. And there's a lot of power in that. So just keeping that in mind. So I like to give you guys my kind of like loose 8 steps to get started. This is for all of you who are raising for the very first time. Set your goals, right? And we talked about some of those. So like, what is your goal for the amount? Ideally, when do you get the money in the bank? Who's your ideal investor? Identify who that ideal investor is and identify those targets. One of the great things about doing this with like an angel list, a Crunchbase, a Pinch, by the way, here I would definitely include PitchBook now because there's sneaky ways to get access to that. It's super expensive otherwise. So if you guys need insider tips on how to do that, I'll let you know. But take that time up front to find those people. And what's a lot of fun about that is that you'll find out that they're like in Toronto and Halifax and Ottawa and San Francisco and Singapore and like Berlin, like who cares where they are, right? If they understand your industry and they understand your business model. So like D2C guys, like New York City, Silicon Valley for sure, probably London, like as like markets where there's like a lot of D2C investors, right? So very like, they don't care where you are, you know, a lot of cross-border investor happening, which is great. Select an investor, or sorry, a lawyer with experience. Absolutely, please, please, please. If you have any questions, if your law firm is not any of Inc., Osler, Fasken, do me a favor, send me a quick note on LinkedIn and be like, this is my lawyer. And then I will just send you one word, yes or no. And then I'm happy to make an intro. and then build your forecast as we talked about. We talked about the data room or the DD folder building. Notice here, build your pitch deck, 6th, not number 1. The pitch comes later, like get everything set up. And there's a fun part to this. Remember we said earlier, angel investors are human beings, hopes and fears and dreams. Like I gotta tell you, the number of times where like I pitch you and then you're like, Keith, great pitch, send me your data room. Like that can happen with your very first pitch. And here's the problem. If I'm not ready and you're like, send me the data room. And I'm like, I will, as soon as I got it ready. You're like, okay, Keith's not ready. How long is it gonna take? 3 days, 5 days, 7 days. After 7 days, it's like, you weren't ready, you're dumb, or you don't care about me. Either one of those is bad, right? Make sure you're ready to go. So identify the warm ways to get intros. You can still cold call in the modern world, but you have to do it like a cold call sales strategy, right? So you don't try once, right? You try 5, 7 times. You find out if they're speaking at Web Summit or like whatever. Like that's the point, is like get in their face. Fun story that I like to tell because Web Summit's coming up. How many people do not have a ticket for Web Summit? Okay, thank you. Good. Super expensive. I'm not surprised. So here's the important part. You guys have access to all the speakers and you can see all the side events that are happening. People are posting it on LinkedIn and stuff, which means you can find all the investors that are coming to Web Summit, but you can't afford the ticket. What's the good news? There's a coffee shop across the street. So what you do is you send emails and you're like, hey, I see that you invest in my industry. I'm gonna be at Web Summit too. Want to meet? And I'll be like, yeah, let's do that. And you're like, awesome. How about like 8 a.m. on Thursday? And I'm like, game on. And you're like, cool. Listen, it's gonna be chaos here, like freaking 20,000 people. There's a great coffee shop across the street. Why don't we meet there quieter? And they'll be like, yeah, good idea. You know. And so I actually did this the first time I raised in Silicon Valley. I went down to a conference. I had no money. I was couch surfing. I literally went on LinkedIn, found like a Canadian expat living in Redwood City, actually. And I was like, hey, I'm a fellow Canadian coming down. He's like, oh, you're gonna have so much fun. And I'm like, I bet you I have more fun if I sleep on your couch. And he's like, yeah, come on in. Like, so seriously, totally, it was awesome. And then what I did is I set up these meetings and I did that exact technique. I was like, Starbucks across the street, back when Starbucks was cool. And so I was like, let's meet there. And so this one corporate VC did that. And so like I had a meeting and then like I was preparing for this next meeting and then he came in a few minutes early, 2 o'clock. And he came into and I knew his face from his profile. And, you know, he came in and he has conference badge, you know, he's looking around. And so I stood up and I was like, hey, you know, and he comes over and he like walks up and he looks at my chest and he's like, oh, you don't have a ticket for the conference, do you? And I'm like, dude, I'm a startup entrepreneur raising money. Like, of course I don't, right? And he laughed, he's like, well played, you know? So we had our meeting and then he's like, what are you doing after this? And I was like, oh, I'm done my meetings for today. He's like, come with me. Walked across the street into the conference hall, walked right up to the registration desk and he's like, this guy's a friend of mine, give him a ticket. Now it happened that he was a good corporate VC and he had some pull, but then I had a ticket for the rest of the conference and he invested in my company. So, right? So you guys do it. Don't applaud me. I'll applaud you when you do it. So the important part is do that work. Now, in terms of managing the investor funnel, so this comes to funnel probabilities. Initial call meeting, are they interested? 10% probability to close. Follow-up meeting, 25%. Due diligence commences. This is 1 meeting worth of due diligence or it's 6 months. Again, individual investors. Now, here's the trick that I like to do. If I have 3 meaningful conversations with an investor, at least an hour each, and I like the rapport, I get to the end of the 3rd meeting and I'm like, you know, Carl, I've really enjoyed our conversations. These last 3 meetings, I've gotten to know you a little bit. You've gotten to know me a little bit. You know what? I think you could be a great addition to the cap table. I'd love to get your perspective. Now, notice I didn't say, are you in or out? Because if I say that, it's binary. He can only say yes or no, and I don't want to risk no. So what I say is like, hey, so what do you think? And then you're like, yeah, this is not really a deal for me. Or you say, you know what, actually, yeah, like, you know what, I think I send me the term sheet or send me the paperwork or whatever they say, right? Or they might say, you know what, yeah, this is cool, but like, I'm going to need to learn more about X, competitive framing, financial model, whatever the case may be. There's one other answer they can give you. Keith, this has been great. Keep me posted. That's a Canadian no. And you're like, so whenever somebody says like, yeah, keep me posted, you're like, I'd be happy to do that. Now, in the context of doing that, tell me what I can share with you that will help you get to a yes or a no. So this is where, with much love, we pin them to the wall and we're like, you need to tell me what it's going to take to get you to a yes or a no. Now, I will tell you, when you do that, you have to screw your courage on, because a third of the people will automatically say they're out. They're just giving you a Canadian no, right? Keep me posted. And you're like, no, tell me what it would take. Yes or no? And they're like, not really. Okay, no problem. Do you know anybody who would? Like, you know what I mean? Like, just be like, great. But what will happen is, if you say, hey, tell me what it would take, keep you posted, but tell me what to keep you posted on. What will it take? And then they'd be like, well, you know what? Actually, I really don't think you're different from the competition at all. Or like, you know what? You just don't have enough progress, or like whatever. They're going to say something. Then you can act on it. And that's power, right? Like that changes everything, right? The other thing they could say is like, so who else is in? So now what they're signaling is, I'm interested, but I'm not going to lead. So you need to tell me that there's some other, like, a confirmation that this is a good deal, either a formal lead or some other like aggregation of investors. So then you might say, oh, Keith, thanks for asking. Like, Angie and Justine are in, they put in 250. Be like, oh, okay, well, in that case, I'm in. Or I'd be like, well, what I really need to see is, so if you ever, anybody is like, keep me posted, do not let them off the hook. I will gladly keep you posted. What should I keep you posted on? What will help you get from the yes to no? Yes, screw on your courage. 33% are going to close the door. It's okay. It'll save you time and effort in the long run. Okay. Verbal commit, we talked about. Additional due diligence may or may not happen. This is an optional step. Some people might just say, send me the paperwork and I'm writing the check. Then review the paperwork. Now we get into some additional negotiation. So this is the time when people actually have the paperwork in front of them and you're like, hey, like my valuation is 8 million, right? And then I'm like, you know, so I don't know if I feel good about that. This is when you're going to start to get some of that negotiation, right? Now I'm going to say something. Remember we talked about dominoes on the board. Paperwork is this funny thing for all of you. It's like literally, it's the most ethereal thing. It doesn't matter what the paperwork is. The paperwork, any and all aspects of the paperwork can change all the way to the final check. So I know that's going to sound a little crazy for you guys, but my encouragement to you is your goal. Remember the very definition of herding cats, right? So if I'm like talking to you guys and you guys have like safe agreement, discount, 8 million cap, and then I'm coming over here and you guys are like, it really feels like 7 million. And I'm like, yeah, I need you guys in. Okay, great. Hey, everybody, good news. It's going to be 7 million cap. And you guys are like, great, even better than before. And then I come over here and she's like, I only do convertible notes. So I'm going to give you guys a real life example. I was working with a company raising $500,000. We had $400,000 in. It was actually a common share round, a price round. And all the paperwork, people, $400,000 worth of checks in the bank cashed and being spent, signed contracts. And at the 11th hour, we met a person and they're like, no, I really like a convertible note. But the hook was, that wasn't just any investor. They were the white elephant. They were the perfect investor. They got the industry, they got the business model, they had the contacts, like they had everything. And then we said, so what would you want to see in that note? So then we had a 25-minute conversation about like, what about this interest rate? What about that? Blah, blah, blah. We said, okay, we're going to think about it. So then the investor left the room and we literally turned around. We called every one of the other investors. We're like, hey, like, so excited that you're in. And they're like, yeah, it's exciting. We're like, remember the common share? And you're like, absolutely. We're like, so your name?
Carla.
Carla. So we're like, hey, we met Carla and Carla like has this background. And then you would be like, oh, perfect. And we're like, absolutely. We think we've got her in. One thing. You're like, tell me. We're like, We're taking all the paperwork that you guys all signed for $400,000 and we're gonna burn it.
Yeah.
And we're gonna replace it with a convertible note. Now, here's the difference in terms. Here's how it's equal or better for you. So we actually spelled it out to the investors. And then there was 12 investors over here and they're all like, yeah, we're good. So we tore up all the contracts. We sent you all fresh contracts. You guys all signed it, she signed it, and then we finished the round. So it's just really important to know, you can negotiate anything here. The rule is the bedside table. You guys know why I'm saying that? Because you're gonna negotiate with me now and you're gonna go home and you're gonna open a great bottle of red wine. You're gonna enjoy a glass of red wine. You're gonna watch your favorite show, Cleo, if anybody's curious, Netflix. And then you're gonna have a good night's sleep. And when you wake up, you're gonna see your phone on the bedside table and you're gonna be like, is that a fair deal? There is no objective math here. You're gonna negotiate with people. You need to be able to sleep on it, wake up in the morning and say, I think this is fair. If it's fair, do the deal. If it doesn't feel right, don't do the deal. Does that make sense?
Yeah.
Okay. And then of course, signed paperwork, still only 90%, and money clears the bank. Signed paperwork, last round that I personally did, I had a good friend of mine who said he was in, I sent him the paperwork, he signed the paperwork. 2 weeks later, I was like, great, here's the wire details, no answer. Okay, so I waited a couple days and I was like, hey, Steven, like, wire the money, no answer. I called him, no answer. So now I'm starting to worry, I started calling around, nobody could find Steven. So this is June 12th is when I had sent him the email. September 10th, my phone rang and it was Steven. And he's like, hey, Keith, and I was like, oh my God, like, I thought you were dead. Like, where have you been? House is dark, like, he's a friend, like, I literally knew where he lived, And he's like, yeah, he said, yeah, like, my wife and I were talking one night, we just decided to go on safari now. And we did. Because they're investors, and what are investors? They're rich. So that's what they did. They left on July 11th over dinner. They decided June 11th, June 12th, they were on the plane. And they flew back on the 9th of September. So here's my encouragement to you. Technically, we talked about a start date and an end date. If somebody signs the paperwork and disappears, you freaking hold that round open because you will guilt the hell out of them to write that check. So when Steven called me on September 10th and he's like, hey, and I was like, oh, this sounds amazing, blah, blah, blah. He's like, I'm so sorry I missed your round. I'm like, you didn't. I'll resend the wire info.
Kept it open for you.
I held it open for him. Yeah, and he's like, oh, okay. And so he invested. There you go. So a couple of things that I want to cover off. How are we doing for time?
We're over.
Oh my God, we're over. You guys want to keep going for 10 more? 10, 15 more minutes? Okay, if you guys need to run, it's totally fine. We are recording this session for everybody online. I really appreciate it. Just a few things. Remember, investors are not your ATM. Find alignment, right? So do they know your industry? Do they have experience with your business model? Are they aligned with you from a values perspective, right? It is important to note that 98% of investors are good people. There are a few bad apples. Just make sure you kind of keep an eye out for that. You can do as much homework on them. I love it when entrepreneurs ask me for references, right? You're like, hey, Keith, like, I'm excited. Like, we're going to do this deal. Could you introduce me to one of your CEOs to see how, like, they made this relationship work, which is code for I'm checking up on you. Good. I'm going to own a piece of your company. You do reference checks on employees. Please do reference checks on people who will own a piece of your company. Okay, great. Do they get your geographic market? This is very important. I find the #1 source of friction with investors after the check is exit. Right? So it is important to note, like, typically speaking, what you want to do is as you get to know an investor, as things start to warm up, you want to be able to convey to them your exit strategy. Right, what you're planning on doing, of course, between here and there, nobody knows what's going to happen. But the point is like, if you guys are like, hey, we're going to sell in 3 years, tell people, right? Because sometimes people are super aligned on that and sometimes they're not. But if they're not, it's a problem. And so there's a famous example in Vancouver of a company where the two co-founders who were actually like, frankly, young guys like the two of you, and they were like, hey, like, we're gonna build this billion-dollar business, which is kind of like what Ryan Holmes said with Hootsuite back in the day. So like, we're gonna build this billion-dollar business, it's gonna be completely amazing. And so investors signed up, and then about a little bit less than 2 years later, somebody came along to offer to buy the business. And it would have put about $8 or $10 million in both of their pockets individually, right? And they were like 26. So imagine like somebody's offering you like a $10 million check at the age of 26, you're like, yes, please. You know, so they called all their investors and they were like, hey, good news, we got an offer to buy the company, isn't this awesome? And the investors were like, no. And the investors killed the deal. And you guys need to hear this, not shame on the investors, that's shame on the founders, because they never said that they would totally green light to sell it like in a hurry. Right? So because investors, like some investors want to change the world. Some people want their money out in 4 years. Just ask to make sure you're lined up. Right? And if you state what you're planning on doing, a tiny subset of investors will say, you know what, that's not right for me. But probably better to get them out before than after. Right? True story. I had an investor one time who literally called me 2 years after he invested. He's like, hey, Keith. And I was like, hey, and he's like, I want my money back. And I was like, pardon? Like, and I actually thought like something was wrong. Like I thought he was like sick or like cancer or something, you know, like, I'm like, oh my God, is everything okay? He's like, no, my wife and I just want to renovate the bathroom. I'm like, okay. And I'm like, but I can't help you. I'm a private company. Like, this is totally illiquid. Like, you know, and he called me every day for 6 weeks straight. He was so upset with me. I'm like, you know, but I never asked him. So shame on me. So final pieces. Remember, whose company is it? Whose company is your company? It's yours, right? It's your company. So please do note, you guys start, like you guys set your initial paperwork, you set your initial terms. Please remember, you're not saying you're setting them in stone, you're proposing terms, right? Yes, some investors will say, great, you've proposed that, I think other things, good. But the point is they're now negotiating off of your position. So, but a couple things, if you go out there and you're like, hey, so yeah, I haven't set my terms yet, I'm waiting for a lead. People are like, okay, you're indecisive, you're not driving the bus. How is this indicative of how you run the business day to day, right? Drive the bus, pick your lawyer, pick your accountant, get the paperwork, get the data room, drive the bus. Right now, as I said earlier, 75% of the deals out there right now are safes. So if you guys are looking for the easiest way to get started, you're probably going to start with a safe because that's just what everybody sees. Convertible notes are probably like 15% of, you know, the remainder. Like, so it's very small number of comments or prefs. And then you need to set the default terms. Start at 20% dilution. We talked about that earlier. Like if I'm walking in the door and you need to decide how you're going to create the argument that you're going to give up less than 20% because that's your goal, right? Linking to revenue, like in terms of like a financial forecast for valuation really starts at A round for most businesses. You can start to do some discounted cash flow or DCF like at pre-seed and seed, but it is very theoretical and it tends to be to the detriment of the founder to do that. Go with comparable transactions, right? Have DCF if you need it as a backup, but go with comparable. And then safes and notes are great because it pushes this conversation about valuation down the road. Go ahead, Carl.
Is the regular route to go pre-seed, seed and A, or is there always a pre-seed?
So good question. So for the folks online, the question is the common approach pre-seed to seed to A? And so my comment to you is that's the, let's call it the textbook way to do it. Every business is different. So I've seen companies like do friends and family and they jump right to seed. I've seen companies actually, there's a handful of companies that have gone right to, like they bootstrapped it right to A round. I've seen other people do like 2 pre-seeds, a seed, 2 extensions, and then an A, right? Prashant, I know a few companies who have wandered down the river a little bit like that, right? So I think that that's an example. Go ahead.
You choose to do a safe and pre-seed, does it affect your next round? Because you haven't technically stated the term for evaluation?
No, it doesn't. Safe agreements first came into play in 2012, so they've been commonplace now for about 13 years. They launched in Silicon Valley. So it's actually quite common now to see how people will do a pre-seed safe and then a seed stage safe. And then sometimes a seed extension safe. And then when they get to A round, a bunch of stuff gets priced and all that stuff gets sorted out. So quite common to see that happen. Go ahead.
I just want to share a quick shout out for a great tool that exists. And it's
Please.
easy to use. It's actually built by New Ventures. And a partnership of New Ventures and Innovate BC. It's called capitalcompass.ca.
Yeah.
So you shared about PitchBook, Deal Room, TechCrunch, et cetera. So if people go and create a free account on capitalcompass.ca, you can actually see all the information you're asking for right now on the tool. Search by industry, search by company, search by round, search by value. It's all there and it's free.
Yeah, and the benefit of that one, so once again, capitalcompass.ca is those are Canadian deals skewed into BC. So very regionally specific, so hyper relevant. And then when you look at AngelList, for example, that has global deals, but it's very heavily weighted into the US, right? So sometimes you'll see some geographic differences come into play. So just noting here, this is the common paperwork. You'll find this in our learning portal as well. Safe agreement, again, is the most common. And it is important to know that for you, if you guys think you're a rock star, and some of you probably are, common shares are your ideal because it's quote unquote the most democratic, and you give up the least in terms of sweeteners or preferential treatment. In the context of a safe agreement, what you're giving them, if you're giving a discount on a future valuation, typically 20%, and you also set a valuation cap on that next round. So you're giving some sweeteners every time you do one of these. And so common shares, like if you think you're an absolute rock star, common share is for you because you can be like, look, we're the bomb. So, you know,
Do
take
you
it or
guys
leave
do
it.
warrants in the tech space on the common share?
Rare,
A unit?
rare.
Okay.
Yeah, where you will see warrants, and if anybody wants to like chat later over cocktail, we can talk about what warrants are, but warrants is an additional sweetener. Where you might see it, in a tech deal is, say, for example, I invest in Carl today, which is April 24th, 3rd, April 23rd. So let's say this round is still open at the end of October and you're still taking money. And then I'm like, hey, like you should have closed this round months ago. Sometimes you'll give me a warrant as a sweetener because I was way early first in. So sometimes you'll see a warrant get pulled out for that.
Okay.
Yeah, sometimes as well, you'll also see it if you get like a rock star, like, so I don't know, like say Brian Scudamore from 1-800 Junk Invest, and you want his brand name on the deal. So sometimes you'll give him a bit of a sweetener. Rare, but doable. And then the rise of alternative returns. This is something that's very interesting. It used to be that you do equity or you did equity, right? And now, especially once you get into revenue, you start to see things like revenue-backed financing. So it's a loan based on either a percentage of revenue that's repaid on a percentage of revenue or a percentage of profit. Typically, the return is not an interest rate, but it's a set multiple, right? So say I give you $1 million, you're going to repay 2x or 2.5x to me, whether that takes you 2 years because your revenue takes off, or it's a journey down the river and it takes you 17 years, right? So just noting that revenue-backed financing, especially if you're in revenue, redeemable shares is a variation of that. And the reason is revenue-backed financing sits as debt on your books. It's a loan. Redeemable shares say you create a second class of shares, which typically is Class B commons. And then I invest $1 million, you give me Class B commons, and then the company repurchases those shares over time through a percentage of revenue or profit. So the benefit is it's a second class of equity. It doesn't sit as a loan. So now I can still go to BDC and get my loan, right? So just different tools that we can use. It's in a relationship. It's a relationship. It's a relationship, right? When you're looking at investors, don't think of them as ATMs. Think of them as people who can add value way beyond the check. The other one is like there's an opportunity, of course, to ask lots of questions, get that queue up. Let me see here. Right. It leads to this. Remember we talked earlier about a couple things, top 5% with investors, right? So another way to be top 5% of investors is craft and send monthly update emails. Now, I gotta tell you guys, I literally have said this to, I swear to God, at least 2,000 entrepreneurs over time. And I'm like, this guarantees you'll be in the top 5% because you're top of mind. You're telling me your progress. You're telling me what's working. You're putting asks out there. You saying thank you. So you're top of mind. I've got some energy behind you. Plus the next time we meet, you don't have to spend 20 minutes rehashing what's happened. We can dig into the important stuff. And every time I do this, coming out of here, 5% people. So my encouragement to you is don't be the 5, don't be the rest. Like send it. And it's super valuable. There is a template in our learning portal for this. So just make sure that you grab it. Okay, go ahead, Carl.
Quick question that,
Yeah.
circling back a little bit, because you were talking about 20% dilution earlier for the round.
Yeah.
Is 20% sort of the standard for every round,
No,
or is that a change?
20% is standard for pre-seed and seed.
Yeah.
And then it can get pretty variable when you get to A round and beyond.
Yeah.
Typically speaking, there's a bit of, you guys know, you've heard of the Valley of Death, right? When you've got like your early customers and you gotta try and leap over into a bit more mainstream customers.
Yeah.
So in the world of capital, the Valley of Death is between seed and A. And so typically if you get to an A round, you got a bunch of momentum behind you. Typically, you're not giving up as much equity, depending on how much you raise and a few other parameters.
Mhm.
Typically speaking, yeah. But yeah, it can get pretty variable once you get past that. Yeah. Yeah, and then just remember that stuff happens. And so I'll give you guys the context. There was an entrepreneur in 2015 in Vancouver, and they were raising around, and month one, they sent their monthly update email, and it was like sales up and to the right, like plus 20%, churn rate down, like it was great. Like, like everything was like champagne and roses. It was awesome. And there was a lot of excitement in the deal, both in Vancouver and in Seattle. And then month 4, the founder sends the update email. It's like sales down 78%, churn up. Like, it was just like top 5 metrics were all negative. They were all bad. And so at the end of those 5 lines, like that founder had the undivided attention of every investor reading that email.
Mhm.
And then what was the next line? What happened? ? And then there was a paragraph of like, so this is what we did, this is what we thought, this is what we thought would happen, et cetera, et cetera. And, we were wrong, right? And da 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 da. Next, what did we learn? Da 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 da. Paragraph about what we learned. Next one, what are we going to do about it? Paragraph on that. That email with 5 key metrics, all double-digit negative, that founder raised 1.5 million within 30 days of that email. Because people were like, okay, it's real. Let's go do this deal. Right? So I just want to make sure you guys know, like, when you have bad news, every business has bad news in it. Don't hesitate to share the bad news. The key is how you share it.
Right.
So you don't call me and you're like, oh, I lost my biggest customer. Oh, what are you gonna do about it? Oh, we'll get a beer and I'll figure it out tomorrow. Don't say that, right? You're gonna be like, Keith, I lost my biggest customer. Here's what happened. Here's what we learned. Here's what we're gonna do about it. So, because I'm gonna find out anyways. Like, it's freaky how investors find out everything bad that happens, right? I had a situation, final comment, we're done, by the way. We had an entrepreneur from Halifax, and they were pitching BDC Thrive Lab, female founder. And they were pitching, and they had a final meeting. And in the final meeting, they were gonna get the yes, because I knew BDC was in. And then the night before at 9 p.m., the co-founder said to the CEO, I'm out. And the co-founder was the CTO. So she called me and she's like, what do I do? And I'm like, what do you think you need to do? And she's like, I think I need to tell BDC. And I'm like, you do? She's like, they're gonna walk away, aren't they? And I'm like, yep. And so then we talked about what she was gonna do about it. And within 3 months, she helped that original co-founder exit the business through a combination of sale plus time-based kind of renewing shares. Hired in new tech talent, closed 3 customers and closed around larger than she anticipated. Because she was like, okay, something bad happened, let's go figure it out. Okay, so a couple things. You guys will all get an invitation to the learning portal. It will have deep dive information in 12 different sections, of which data room, sustaining momentum in the round. There's an entire section on sustaining momentum as you go month over month, trying to like get through to close, negotiation, post-round engagement with your investors. We are also, Spring is having a founders event on April 30th, linked to Road to Web Summit. I'll make sure you guys get the link so you guys can attend if you want. It's of course free. And then 2 other things are coming. One is funding roundtables, and funding roundtables are facilitator-led peer groups. 5 to 7 entrepreneurs at the same stage of fundraising to help you get your checks in. It's not a program, it's not a workshop, it is 5 to 7 entrepreneurs getting their rounds done. So we're gonna be launching that coming up April 30th. I will say that as a part of that, Pacific Can is providing part funding, so it's actually super deep discount. It's just a make sure you show up fee, just to be clear. And then we're also launching a growth studio, which is a variation of a venture studio. And that's 100% bespoke support to help companies unlock growth. So that's what's coming up. You guys will get emails on all of this. Thank you so much for letting me run long. I never have.